Welcome to Finding Your Piece of the Rock on ThinkTech Hawaii. I'm your host, Abe Lee. I've been a licensed real estate agent since 1973. I'm the owner of Century 21 iProperties Hawaii and work with over 100 wonderful agents in real estate sales. I started Abe Lee seminars in 1980. I have taught over 10,000 students to get their real estate license and taught continuing education classes for real estate licensees every 2 years. Our show is dedicated to helping buyers and sellers understand the process involved in a real estate transaction. Our special guests will talk about legal issues, escrow, title, getting a loan, surveys, home inspections, insurance, contracts, wills and trusts, and much, much more. My special guest today is Daryn Ogino, president of Smart Money Hawaii. Okay, my special guest today, Daryn was born and raised on island of Oahu. He's a University of Hawaii and Manoa graduate with a degree in information technology management. After college, he spent a couple of years doing IT work, but eventually gravitated to the real estate industry after buying his first home at age 24. Daryn has been in the mortgage business for 18 years, and 15 of those years as president of Smart Money Hawaii. In the last 5 years, Smart Money Hawaii has done over $1 billion in loan volume and over 2,000 transactions. His passion for financial education has been the key to his success and has allowed him to be a top mortgage broker in the state of Hawaii. Daryn, thank you so much for being with us today.
Thanks, Abe. Thanks for having me.
Our
Great
pleasure.
to be in the presence of the great Abe Lee.
Thank you. I paid him to say that, by the way. Okay. So Daryn, tell us, how did you get into the mortgage industry?
It's kind of by accident, really, Abe. You had mentioned earlier, I was in IT for a couple of years because that's what I did for college. But I bought my first home when I was 24, and the mortgage payment was a little too much for me to handle. So I had to get a roommate to help subsidize the payment. And my roommate one day came back home and was talking about a new job that he got at AmeriQuest Mortgage and how he absolutely loved it and the money was good and he helped a lot of people. So I started looking into it because I was already a homeowner and I was really curious about how financing worked. Even going through the process once and being a homeowner, I still was confused on how it all worked, how I even got the loan, and what I'm supposed to do next. So I applied for a job at another mortgage company in downtown and actually got it. This is before regulation of licensing and pre-licensing for mortgage originators. So I was actually able to just apply for a job and get a job as a loan originator. So that's how I started.
Okay. Then how did you start your company?
That's another interesting story. So I started my company in 2008. So if you refer back to that year, that's when we had the Great Recession, the subprime mortgage meltdown, and I was working for another mortgage broker at the time. And during the subprime meltdown, a lot of mortgage banks and brokers were closing shop because interest rates were rising, lots of foreclosures and short sales were going on, and my mortgage broker actually closed his doors, and I wasn't ready to go yet. I still was doing great at what I was doing at the time, and I wanted to continue doing mortgages. I applied for other jobs at different banks, but as you know, during the subprime meltdown, no banks were hiring. They were actually letting people go. So really, the only way for me to stay in the business was for me to start my own company. So again, quite an accident for me to do that, but it's a blessing that it forced me to start this business on my own. Otherwise, I'd probably be working for someone else or out of the industry altogether.
Okay. Now, how many loan officers do you have working with you?
Currently, including myself, we have 18 licensed MLOs in the company. We are a locally owned and operated company. I am the president and 100% owner. So all of our revenue dollars stay in the state of Hawaii. And, our goal is to help the locals stay home and not have to, look outside of Hawaii to be able to live,
Okay. So what do you do in your business to help home buyers with their loans?
Our main focus is financial education, first and foremost. We do seminars and webinars every so often. If you go to our Instagram page, Smart Money Hawaii, you'll find a lot of tips about home ownership or, showing you how to get a loan or how to qualify. But to me, the best way is to do a one-to-one with one of our licensed originators or myself even, because I'm still an active originator. I still talk to the clients on behalf of my loan originators as well. And the one-to-one pre-qualification meeting is probably the most important because everyone's situation is different. So we need to approach it in a more holistic manner and look at everyone individually and, create a roadmap that is customized to them.
Okay. So can you walk me through the loan process? I'm brand new. I have no idea what the heck I'm doing. And my realtor found me a house or a condo and I like it. So now the realtor will probably introduce you to me as a home buyer, right? Because we don't know anybody.
Mm-hmm.
Then what happens?
Mm-hmm. Well, it's pretty simple. I mean, you have two things going on at the same time, right? You have the real estate, which you would handle, and then on the loan side is fairly simple. The first step is to complete a loan application, either online or over the phone with a loan officer or loan originator. And from there, you have to follow the rule of two. So typically, 2 pay stubs, 2 W-2s, 2 bank statements in order to get a pre-approval. If you are self-employed, 2 years tax returns. Okay. Once you're pre-approved, then you're free to shop or look for homes with your realtor. And at that point, we're kind of out of the picture until you find a home, but we're still here to help you, answer any questions about financing that you come across along the way. Once you find your home, we already have a lot of your information. We may have to get updated documents, like maybe updated pay stubs, but we already have all the other documents that we need. And your loan submission will now go to an underwriter. An underwriter is just verifying that the income and assets that we stated and provided are true. And they may have other questions where they may ask you for other conditions. But in most cases, it'll be very minimal. And at that point, you'll get into final loan approval. After final loan approval, you sign your loan. The loan gets funded, meaning the lender will send the money to escrow. And then a few days later, your loan records, in which now the realtor is able to give you your keys. So all of this happens within a 30 to 45 day window. And the speed of how it happens really depends on how quickly you respond and get us your information.
So what's the difference between what they call a pre-qualification letter and a pre-approval letter?
Yeah, great question, Abe. So those terms get thrown around quite a bit, and still to this day, people are confused on what it is. The pre-qualification letter is based on what you submit on your loan application. So I don't have any proof. So you haven't sent me any pay stubs, W-2s, tax returns, or bank statements. I have no proof of your income or assets. I'm just relying on your word, what you put in your application as what you're qualifying for. So that's a pre-qualification. A pre-approval is different because we actually review and look over your pay stubs, bank statements, W-2s, tax returns. So we're letting the seller and the listing agent know, hey, you know what? We looked at their actual hard documents and they are pre-approved to purchase this home. So obviously a pre-approval will be a much stronger letter to have when you're trying to make an offer.
Okay, so what is this debt to income ratio that you folks look at? You look at two things.
Yeah.
I guess it's for the mortgage payments and then it's everything else, including the mortgage payments?
Yes. In our industry, we call it the front end and the back end. So the front end debt to income, also known as DTI. The front end DTI is your principal, interest, taxes, and insurance, plus HOA dues, if you have any, divided by your gross income. And then you have a ratio or percentage for your housing payment. Then you have your back-end DTI, which is the housing payment, plus all the monthly liabilities that show up on your credit report. So when you add all those liabilities plus the housing expense divided by a gross income, we have your back-end DTI. The back-end DTI is more important because that's what the underwriter is looking at. Typically, an underwriter will want anywhere between 45% to 50% debt to income ratio. There are exceptions to the rules, and it really depends on the type of loan that we're doing. So without getting into too much detail, this is why it's important to meet with someone that understands how to get you a loan, because otherwise you're just guessing, and you won't know what type of loan program that you can qualify for without actually providing some of your documentation and doing an online application.
Okay. Now, what's the difference between a credit report and what they call a FICO score?
Yeah, so the credit report is a combination of all of your liabilities. It shows the different type of loans that you have, credit limits, credit balances, any type of delinquencies, inquiries, even bankruptcies will show up on a credit report. So it's a snapshot of your history of how you pay bills that's given to the lender. On the credit report, there's a thing called a FICO score. So a FICO score is actually a shortened term for Fair Isaac Corporation. So Fair Isaac Corporation is a data analytics company that was established in the 1950s, and it's just been adopted as the go-to scoring model for credit. So that's what FICO means, and how you pay your bills, how you how many loans you have, how recent your loans are, will determine your FICO score. And FICO ranges from 300 to 850 points, and being above 700 would put you in a good FICO score, and being above 740 would put you in an excellent range for FICO.
Okay, so if I have a low FICO score, will my interest rate be higher? And vice versa, if
Absolutely.
I have a high FICO score and I have a lower interest rate?
Yeah, so this is why credit is so important and why we need to start early, because you're absolutely correct, Abe. Having a lower FICO score will definitely make things more expensive for you. You have higher interest rates that will be available for you, and it'll make affordability a lot harder if you don't keep up with a good credit score. Part of the pre-qualification process is reviewing your credit report and making some recommendations on how you can improve your credit score. In many cases, people aren't buying, on the right after the pre-qualification. They're buying a home sometimes 2 to 5 years later, and it's because they need to work on getting better credit. So the two things that really affect interest rates on, like, if you're going to get a better interest rate or a worse interest rate, is FICO and the amount of down payment you're putting. The better credit score you have, the better interest rate you're going to get. The larger down payment you have, the better interest rate you're going to get. So if you have good credit and a decent sized down payment, you'll probably get a lot better interest rate than someone that has bad credit and a really small down payment. Well, now if you have a good credit and a small down payment, that's still going to be you're still going to get a better interest rate than that person with the bad credit score. So it's very important to keep your credit up.
Now, the credit report, are there, I heard there's 3 reporting agencies that kind of look at your overall credit history, and then they have different scores or reports. So sometimes, are they all in sync, or are they sometimes different?
That's a good question too. So in the mortgage industry, we pull what's called a tri-merge credit report. The tri-merge credit report pulls the credit from 3 of the major credit bureaus. That's Experian, Equifax, and TransUnion. And the reason why on mortgages they pull all 3 is because some creditors don't report to all 3 bureaus. So the mortgage lenders want to make sure that let's say you had a delinquency on one of your credit cards, and that credit card did not report to Experian and TransUnion, and only Equifax has that missed payment, then your score on the Equifax will go lower. And then because Equifax reported that missed payment, it'll show up on your credit report. So they do all three more to limit risk, just in case a creditor does not report to one of the other bureaus. The bureaus, the credit agencies are using what's called FICO Classic. The most current algorithm is FICO 8, and if they go off of FICO Classic because that's what the industry has been using for years and years, and it's very hard to steer a large ship. Like the way underwriting guidelines have been written were according to FICO Classic, and FICO 8 scoring method actually have higher credit scores than FICO Classic. So if you have a credit card where that shows you a credit score on it, it's most likely using FICO 8 algorithm, which will show a slightly higher credit score than when we on the mortgage side pull your credit report.
Okay, now, how can you improve your credit score or your credit report? What kind of tips do you give for the people to up their score?
Yeah, it's a great question. And it's something that we talk about daily with all of our clients. Even if your scores are pretty good, there's always room for improvement. So there are 5 pillars to really focus on. One is payment history. Payment history holds 35% of your score. So first and foremost, don't miss any payments. You always want to make sure that you make your payments on time. The second one is credit utilization. That's 30% of your entire score. Credit utilization is just the percentage of used credit versus your credit limit. So if you had a $1,000 credit limit and you had $800 drawn against that credit, then you're at 80% utilization. Typically, you want to stay below 30% if you can. I know that it's not always possible because people have bills and there's things that go on. But if you can, your overall credit limit should be 30% utilized for the best scores. Okay. The third pillar is length of credit history. So I see this all the time. People are applying for 0% intro rate credit cards, and then they'll shut down on the one that expired a few years ago, and they keep opening credit cards and closing credit cards. Every time you close a credit card, you're basically wiping away the credit history. So what you want to do instead of closing a credit card is just to keep it open. Keep it open as long as you can. There's no rules on how many credit cards you should or shouldn't have, but you could have 40 credit cards. If they all paid on time and credit utilization is great, your credit score could still be good. Now, I'm not recommending getting 40 credit cards because that'd be difficult to manage, but the longer you have credit history, the better. The fourth is credit mix. So if you only have credit cards, it's not a good thing. You probably want to have some sort of installment loan, car payment, student loans help. So different types of credit also help. And of course, new credit or credit inquiries. I hear a lot of times people tell me, I don't want you to pull my credit because my credit's going to go down. That's typically for people that have bad credit where an inquiry will make their credit score go down. But again, if you are applying for 10 credit cards, even with a good credit score, and you apply for 10 credit cards all at one time, your credit score will go down. So you want to be careful on who you allow to pull credit.
That's what they call a soft pull versus a hard pull?
That's another good question. So a hard pull is an actual inquiry that will show up on your credit report. That's the one that will bring your score down if you have too many inquiries in a short period of time. A soft pull is meant, for us lenders to look at your score, but it doesn't show up as an inquiry on your credit report. The difference is that the rules for a soft pull, as a lender, I'm not allowed to share with you your credit score because that's, I guess, I don't know what the real reason is, but I'm thinking it's because the credit bureaus want to get paid more, to allow you to see your score, right? And that's why when the federal government made a law that requires the credit bureaus to allow you to look at your credit report once per year for free. You can go to annualcreditreport.com and pull your credit report, but they won't give you a score. If you notice, after you get the free credit report, then they say you can pay X amount of dollars to find out your score. So on the soft pull, we can see your score. We know what you qualify for, but we can't share with you the credit score based on the agreements we have with the credit bureaus.
How interesting. So one time I did a credit report, and there's a unpaid hospital bill in Philadelphia. I've never been to Philadelphia to a hospital. So I had to go right to the reporting agency and say, hey, this is the wrong guy. Take me off. So how do you clean that up?
Well, you could do it yourself, like how you did, and write to or call the credit bureau and dispute. We have access to our credit agencies where we can put in a dispute on your behalf. If it's not enough, then we may ask you to write a letter and we'll submit it on your behalf. Medical collections, one of the most persistent things that show up on credit reports, because a lot of times you go to the doctor and you may get a bill in the mail and you may have thought that insurance already paid for it, but you might have missed a copay or something like that. And something that small will show up as a collection on your credit report, because those agencies have timers where they don't really give you too much time. If you're late, they're sending it to a collector, and that collecting agency will report to the credit bureau. In your case, you had a misrepresentation in name, so we have to prove that it wasn't you, for one, and that you never lived in Philadelphia. And the bureaus will dig a little deeper, and we'll find out. And in most cases, if it's not you, they'll just take it right off.
Well, the crazy thing was he had the same name as me, and we're both from Korea. Yeah. And so anyway, it got corrected, but it took some time for them to correct it. So we only have a few more minutes left. Time's flying by, but what kind of loan programs do you have for the potential buyers?
Yeah, I mean, we have so many. I mean, the usual suspects, your conforming conventional loans, VA, USDA, FHA. And now that interest rates are slightly elevated compared to 2 years ago, newer loans are coming out. They're called non-QM loans. I won't get too much into what non-QM means. Just know that there's other options. So non-QMs are DSCR, debt service coverage ratio loans, where if the mortgage payment or if the rent received is greater than the mortgage payment, then we won't even look at your other income or assets. There are bank statement loans, 1099 loans for those self-employed people that write off a lot and their tax returns don't show a lot of income. We have hard money loans for those house flippers or fix and hold people, where you can put 20% down, to purchase a home that is not in great condition and still get money back out for construction, just as long as the after repair value is greater than the purchase price. So there's a lot of options out there. It's hard to say to name every single loan that we have. The main thing is that if you have a dream of home ownership, is to talk to someone like us and figure out where you currently are, and hopefully you're able to do something today. But if not, don't worry about it. We'll have a roadmap plan for you, so we know what your goals are and we can show you how to get there.
Okay, we only have a few more minutes left, and thank you, Daryn, for being with us. But any suggestions on how people can prepare to be a homeowner and to get a loan, and to make sure that they're prepared properly to meet with a loan officer like you folks?
Yeah, for sure. I mean, the best advice that I could give is just not to procrastinate, right? That's the biggest thing. People procrastinate and they wait until they walk through an open house one day and they're like, oh, I love this house. And all of a sudden they're like, I want to make an offer. And they had never in their life, did a pre-qualification or checked their credit. And so they're very unprepared for the moment, right? And being pre-qualified doesn't mean you have to buy something today. So my big suggestion would be to just act now, figure out where you are, and we can build that roadmap for you. you know? So that way, when you are ready 2, 3, 4 years from now, then at least you're not in the dark and you already know how to get there and you already will have a plan in place to get you there.
Okay, and I've been told that you get a Lexus or a Hummer after you've closed on your loan. So you get the house first and the loan, and then you can get any car you want, because then the banks really don't care. But if you get it before,
Yeah.
that may disqualify you from a loan.
Yeah, that's true. And you would think that it's a common sense thing to know, but we come across it a lot. People are buying large ticket items prior to home ownership, and at the end of the day, it really comes down to discipline. Would you prefer to have the Hummer or the Lexus before being a homeowner?
Yeah.
I can't tell you if that's for you or not, right? But if you really want to become a homeowner, then a lot of those luxuries may have to,
Sure.
take a step back, until you purchase your home, because of course that $1,000, car payment is going to affect your debt to income ratio, and that may affect your ability to buy something or to buy something in the price range that you want, So yeah, it's always important to, make sure that you can, one, hold a large car payment or any large payment and still get the home that you want.
Daryn, thank you so much. I really appreciate you being here. Daryn Ogino with Smart Money Hawaii, and you have his website. So please, if you have any questions, get a hold of Daryn. Thank you for being here. And thank you, viewers, for watching the show. Oh, thank you. And hopefully it was helpful to you in learning how to get a loan. And if you want to get email advisories to see a complete listing of the shows, then you can sign up for them on thinktechhawaii.com. We'll be back in 2 weeks with another wonderful guest with full of information that'll help the first-time buyers and sellers. And the shows are available on ThinkTech Hawaii archives. So please tune in, tell your friends about the show, and we'd love to have you join us on the shows that we have. For more information on real estate education, please visit our website, www.abeleeseminars.com. And we have a lot of information on the pre-licensing courses if you ever are interested in knowing more about real estate. Thank you so much for being here with us today. I'm Abe Lee, your host of Finding Your Piece of the Rock on ThinkTech Hawaii. And Daryn, thank you so much. Take care.
Thank you so much for watching ThinkTech Hawaii. If you like what we do, please like us and click the subscribe button on YouTube and the follow button on Vimeo. You can also follow us on Facebook, Instagram, and LinkedIn, and donate to us at thinktechhawaii.com. Mahalo.